Hi, Professor Barati here. I want to give you a tip on your mini case financial analysis project this week, and this resource here called Guru Va Focus, and I'll give you this link right here. You can register for this free. It'll give you all this information. It will prompt you to trade up to the premium level, which is very expensive, and you obviously will likely not register for that, but it's a really good financial analysis of any company, just about all the companies on the New York Stock and NASDAQ exchanges, and it will give you some really good analysis of a company you choose to analyze. For example, this is Facebook, and here's its current price. And it gives you these ratios that you can actually click on, and it'll give you some analysis of it. If we go to summary here, it gives you a financial strength, profitability, growth, and then ratios. Currently, Facebook's net margin or profit margin, which you will learn about in this week's class. Net margin is basically the net income generated by this company divided by its net sales. For every dollar of sales that Facebook sells or recognizes, they produce 39.2 cents on each dollar of profit, which is very healthy. And if you click on a ratio here, net margin, it gives you a nice description of what the ratio is. Net margin is calculated as net income divided by its revenue, just like you'll learn in this week's class. On top of that, it will give you its range over the past 10 years. Minimum was $1.04%, maximum is 39.2, and currently it's at its max. Net margin is ranked higher than 96% of the 381 companies in this global industry. So it gives you a comparison. So Facebook is performing better than 96% of its competitors in this industry, which is excellent. And so you can highlight it here versus industry versus history. It'll give you the same analysis. Return on equity. You'll learn about return on equity in the DuPont model. Return on equity is essentially the net margin right here multiplied by the return, the asset turnover, which I don't believe they give us here, the asset turnover. But those two multiplied will give you return on assets. And multiplied by the leverage ratio, which is part of the DuPont model, will give you ROE. So for every dollar investors give Facebook, whether it's retained earnings or equity, Facebook is returning to their investors 23.88 cents on each dollar, or 23.88% return on equity. Compared to the industry, it's doing better than 85% of the 349 companies in the global internet industry. Excuse me. Historically, it's at its max, so its low is 0.38, medium is 14.28. Here's some other ratios which you'll learn about. Current ratio, which is current assets divided by current liabilities, which is a liquidity ratio. How well Facebook can pay its short-term obligations on the liability side of the balance sheet. Facebook has a current ratio of 12.92, and it indicates the company may not be efficiently using its current assets, because this is a very high number. You want it to be around 2x over liabilities, or a ratio of 2. In other words, what they're saying is they have probably too much cash on the books, and it's not efficiently investing that cash. But nevertheless, it doesn't have a liquidity problem. They have no problem paying their short-term obligations. Other important factors is this weighted average versus ROIC, and it gives you a nice description. We'll learn about the weighted average cost of capital in a few chapters. Return on invested capital measures how well a company generates cash relative to the capital it has invested in its business. The capital invested in business is basically going to be the long-term debt that it has to borrow to fund its business, plus the equity section that basically is funding the business. It's also called return on capital. Facebook's annualized return is 51.3%, which is outstanding. And its weighted average cost of capital is only 6.16. So it's obviously using its capital wisely and creating wealth or value to stockholders. Another area that can be helpful is this 30-year financials. Now, to get all 30 years, you have to subscribe, but it does give you all your financial stats, at least from a trailing 12 months, the last 12 months, the end of 17, 16, and 15. So you can get at least 3 good solid years of comparisons, plus a trailing 12 month. And it also will do its return on equity. Look how Facebook's return on equity has been climbing. Return on assets has been increasing over time. The return on invested capital has been increasing over time. And it's probably a correlation to its share price. Notice the share price has been going down. I believe you can also export this to Excel in the export function. Let's see if it does anything, but that could be helpful. Discounted cash flow. Basically, it's using the weighted average cost of capital, and it's saying that the growth rate over the next 10 years is only 5%. And it values the stock. It's saying Facebook is only valued at $57.68 versus $183, because it's saying that Facebook's growth rate is going to be much lower over the next 10 years. So you might want to be careful about investing in Facebook. However, I think the 5% growth rate is fairly understated. It gives you per share data, and right now it'll give you dividend history. Right now Facebook doesn't pay a dividend, so there's nothing there. And again, I think this could be a very, very helpful analysis. Just click on these. Day sales outstanding, which you'll cover. Facebook's accounts receivable for 3 months ended is $5.8 billion. Facebook's revenue for the 3 months was almost $12.9 billion. Hence, Facebook's day sales is 41. So it takes about 41 days to collect, which is improving because, well, currently it says over the past 10 years it's at 68.9, almost 69 days to collect. Currently, over trailing 12 months, it's at 52 days. Much better than the industry average. It will give you asset turnover, which you'll learn about. How quickly a company turns over its assets through sales. It is calculated as revenue divided by total assets, straight out of the textbook. Asset turnover is linked to the return on equity through the DuPont formula, which is a highlight in this week's chapter. Again, it actually gives you the formula right here, which will help you see where the numbers are coming from a balance sheet and an income statement, and you can simply use that as an assist. So essentially, I'm going to give you this link. It should be a great resource and good comparisons and give you plenty of history. Thanks for watching.